Grow your wealth and diversify your investment on unit trust via the HSBC Internet Banking. Here's how you can invest instantly. Log on to hsbc.com.my/UTB. You'll find more than 80 retail and wholesale funds to choose from, so you can diversify to manage risks. You can even invest in both local and foreign currencies. Buy, sell, or switch anytime you like. What's more, you can make fun comparisons with regularly updated market insights. With everything HSBC has to offer, you have total control to diversify your unit trust investments online the way you want it. So invest with HSBC Unit Trust via your HSBC Internet Banking easily today.
Allion, at your service. The global markets, especially the US Foreign Trade Index, is open. More opportunities to invest, more choices. Did you hear about the good news? Check out how much your holdings have grown since the last investment. Great job! Whenever you're ready to make another investment, you can easy invest with just a few taps.
Hi, what's with the big smile?
It's just my wealth planner. This one is with me all the time.
Your personal wealth planner now on mobile. Stay ahead of your finances in just a few taps with Wealth on Mobile. Now available in the HSBC Malaysia mobile banking app. Invest easier and smarter with Wealth on Mobile. Download today.
Very good evening and warm welcome to HSBC Premier Webinar. Dear valued customer, thank you very much for joining us. My name is Swati, My pleasure to be your moderator today. So for today's webinar, we will share about HSBC mid-year investment market outlook. For the past 6 months, we experienced a significant turbulent market. Now we are entering into second half of year 2022 with a mounting number of headwinds and disruptions. Now, market is still lies with a lot of the uncertainties. So for today's sessions, we will explore together global market opportunities and how to navigate the market volatility. So for today, we will start with the presentation for about 30 to 40 minutes. After that, we'll follow by Q&A sessions. Our webinar will end at 5 p.m. So ladies and gentlemen, below the webinar bar, there is a Q&A box. Please use the Q&A box, type your question and send to us. We will do our best to answer all your questions. So before we start, please do allow me to have an introduction about our today's speaker, Mr. James Cheo. We are very delighted to have James to become our speaker today. James is Chief Investment Officer, Southeast Asia, HSBC Global Private Banking and Wealth. James is a member of the Global Investment Committee for Private Banking Wealth Management. He also a member of the Regional Investment Committee in Asia. He leads the development of investment strategies across all asset classes for private banking and wealth management in Southeast Asia. Prior to rejoining HSBC Private Banking, James was Senior Investment Strategist at Bank of Singapore, responsible for asset allocation and thematic research. Before that, James also served as Senior Economist at the Monetary Authority of Singapore, where he was part of the team that formulated policy actions for Singapore during the 2008 global financial crisis. Without further ado, I hand over the session to James. Welcome, James.
Well, thank you everyone for your time. And I think I want to touch on the theme for today. And the theme is really adapting to disruptions. Clearly, I think the first half of this year has been actually extremely difficult for financial markets. And really, there are some disruptions that are occurring. And I want to explain what's causing the market turbulence. But also, I want to think about things in the longer term and how we could position portfolios in the years ahead. One very crucial aspect, I think, first to start off is to start off this quote. It's not the strongest nor the most intelligent that survives, but the one that is most adaptable to change. And I think this quote is quite useful from Charles Darwin. And I think it's also useful in the sense of how we can formulate and adapt to these disruptions. And I think the current deterioration in financial conditions is a reflection of something bigger. It is the reflection of disruptions from the pandemic. It's a reflection of disruptions from the war that we are seeing right now in Russia and Ukraine. And also, we are also seeing disruptions from climate change. And I want to take in detail in each of these disruptions and to highlight the opportunity as well as the risk, and then how we could think about investments for the second half of this year and also going forward into beyond 2022. And clearly, one of the implications from the pandemic is that it has actually made the world much more indebted. Debt to GDP right now is almost 400% of GDP. So what it does in the short term is that it would boost demand. And we've seen a lot of these borrowing is done by central bank money printing or QE. And as a result, the short-term effects is that you get a stronger boost of demand. And at the same time, there isn't supply that meets this demand. And that's why we are seeing inflationary pressures in the short term. But over the longer term, what debt does to the economy is it's a drag on economic growth. Because what it does is that borrowing is always, whenever there is debt, it's actually borrowing future growth to the present. And therefore, I think it will cause growth to slow down further ahead. And that's why we are seeing the real issue right now is actually inflation. Inflation is actually a problem in many parts of the world, especially in the US. And that's why the Federal Reserve right now has actually increased interest rates and it's on that path towards raising interest rates. And as a result, what we are seeing is that as interest rates increase, almost all financial assets are discounted cash flow from future cash flows to the present. And of course, if interest rates increase, it will cause a re-rating of financial assets. And that's what we are witnessing right now. Of course, different assets will be affected differently. Definitely a fixed income asset such as a bond will be affected by rising rates much more, especially bonds with longer duration. And of course, if for in the equity market, if companies that have that have cash flow that it's not visible would also be affected by rising interest rates. Really because it behaves somewhat like a long duration asset because the visibility of their cash flow is not really very clear sometime back down the road. But of course, the good news is that on the inflation front, there are signs that some of the supply issues that's associated with the pandemic is starting to improve. Of course, one of the biggest reasons why inflation is rising is because of labor. There is labor shortages in many parts of the world, especially in the US. But what we have seen since the beginning of this year, and as a result of labor shortage, wages have actually been increased. And with increase of wages, the workers are actually demanding higher prices, and that's feeding through into the inflation picture. But the good news, at least we are seeing, is that there's some signs that wages are starting to stabilize, especially in the United States. Because in the US, there is almost, for this year, 1.2 million new people entering into the workforce. And with the increase in the supply of workers, that labor shortage issue is starting to abate. And therefore, in terms of the wage increase, we are seeing early signs that wages are starting to stabilize. And also, I think another aspect of inflation, especially in the United States, is also as the economy reopens. At one point, there was shortages in used cars, and that has pushed up prices of used cars significantly. But since then, I think that pressure has eased somewhat. So there are factors that are starting to improve, even without the Federal Reserve hiking rates, especially when it comes to supply chain issues. But also, a lot of the supply bottlenecks also has to do with China's zero COVID policy. And I think on that front, while it's still very early days, there are tentative signs that China's zero COVID policy is starting to ease somewhat in some of the major cities, and that should actually help supply bottlenecks ease. So on the supply side, even without Federal Reserve hiking rates, you will get some improvement down the road. But I think what's happened, especially with the rate increase in the Fed's rate increase, is that it is actually right now fairly contractionary in terms of the economy, which means that the amount of interest rate increase that has been done already, it's already biting into the economy. And I think the most evident area is, of course, housing, because of rising rates, because of higher mortgage rates. We are really seeing signs of a pullback in housing demand. And I think that's going to cause the economy, especially on the demand side, to slowly stabilize. So I think the good news is that we are probably halfway through the Federal Reserve hiking path. We will still see further rate hikes in the next few months. And it's very likely that the Federal Reserve will front load the interest rate increase really to put a brake or to really stop the inflation problem. It's very likely that the next few inflation reading is going to be high and very volatile. We think that inflation would only peak sometime probably in September this year and slowly stabilize towards 2023. And I think that in that respect, this repricing of interest rates is not something, it will create quite a bit of market volatility, at least in the short term. But we don't think that it's going to push the world economy into a recession. But what's clear is that growth is slowing down. It's not in recession territory, but nevertheless, I think that's something that we should continuously watch out for in the second half of this year. And also one very important lesson is that different countries are growing at different paths and different pace. But of course, one of the crucial aspects is that the disruption caused by supply bottlenecks, particularly in China, and also the conflict in Russia-Ukraine has caused higher commodity price, and that actually feed through into higher inflation. And of course, because of higher inflation, central banks have to increase interest rates, which we are seeing right now across the world. And because of that, growth is going to slow down. Because at this point of time, central banks are prioritizing the threat from inflation compared to growth. So they are more worried about inflation, and therefore they have to increase interest rates to slow the rise in inflation. But nevertheless, by doing so, demand will slow down somewhat, and therefore we're going to expect slower growth in the weeks and months ahead. But why we think that despite slowing growth, global recession is not likely is really because different countries are growing at different stage. The US economy is still fairly healthy and strong. The labor market is very tight. Unemployment is extremely low at almost about 3.4%. And wage are still growing very strongly. And despite inflation in the US at above 8%, consumption spending is still quite robust there. It didn't fall off the cliff. And also what's also important is that when you look at different countries, especially in Southeast Asia is reopening to the pandemic. It's adapting very well. Consumption is actually very strong. That pent-up demand. And of course, tourism is coming back in a big way in Southeast Asia. So there is different growth cycles in different parts of the world. And of course, in China's case, China is slowly picking up its economic momentum. It has embarked on quite strong monetary and fiscal easing, while the rest of the world is actually tightening monetary policy. China is actually pushing ahead and easing monetary policy. And I think that effect should start to feed into the Chinese economy in the next 10 to even 12 months. And that effect should already manifest itself probably in the second half of this year and towards next year. It's still early days in terms of the credit impulse and the impact on the Chinese economy. But nevertheless, I think there's something that we are watching out for that could potentially support China's growth and also the growth of the region. But also, I think another very important trend that has occurred is also the huge amount of investment that goes into energy transition. And I think that's something, a capex that would be a support, a pillar for economic growth in the years ahead. And also as supply chains reconfigure closer to the domestic market, that requires investments as well, particularly into robotics, into AI. And I think that's where a lot of the capital expenditure will continue to be quite strong. And therefore, if you look at it as a whole, a global recession is not very likely this year, nor next year, really because of these factors. And I think one aspect that I want to talk about is also that as a result of the pandemic, the world actually has become much more divided. And a lot has to do with income inequality between different countries. So within countries, there is the income gap has widened really because of the changes in asset prices. But also, I think what's also very important is that it has created conflicts also between countries. We have seen that happen between Russia and Ukraine. And I think what it also means is that the trend towards a more unstable kind of a geopolitical world is likely here to stay. And therefore, the shift towards total security, it's going to manifest itself across military spending, across cybersecurity spending, and into many other aspects of how different nations are starting to shore up in terms of their security. And even when you talk about energy and even food security, currently, I think in parts of Europe, defense spending is still extremely small. But because of this conflict, it has actually prompted many countries in Europe to actually increase their defense spending. And therefore, I think that's going to be a trend and a theme that will continue on in the years ahead. One aspect of the pandemic is that it has actually made the world much more digital. It will accelerate how businesses work, and that the need to use technology digitally is imperative. whether how a consumer consumes. You have to use mobile at least to make your transactions. And I think that what the pandemic did was to kind of make a crash course and bring everyone into this digital world. And it's here to stay. Of course, we are right now connected through Zoom. Zoom is a great platform. It's great, but the interactions are still very much two-dimensional. And I believe that in the future, our connection is going to be much more interactive through the metaverse, in which the virtual and the real world, the lines between that, it will be blurred. And that how you live, work, and play will be very much, it will be in virtual platforms whereby the interactions will be much more engaging, whereby you can be an avatar of sorts, and you can be in different places and many at one time. And I think it's this sort of a metaverse that would create quite a bit of an interesting opportunities for investors in the years ahead. But also, I think I want to speak a bit about climate change. And I think one of the factors, and it's also related to the pandemic and also the conflict, is that I think energy transition and security is becoming much more pertinent. And of course, what the war in Ukraine and Russia has highlighted, especially for Europe, is to have energy sources that is diversified and to secure energy sources. And renewable energy is the solution. And I think in the years ahead, you're going to see huge amounts of investments into renewable energy, especially in Europe, really because a lot of these technologies are available, wind, solar, or even green hydrogen. The issue right now is how do you produce this energy at scale at a cheaper cost? And I think that's where we're going to see advancement of green technology in the years ahead. And I think a lot of these innovation is also going to be driven as a result of the disruption that we are seeing occur. One of the also, I think one very important aspect is that in a more complex world caused by the pandemic, there is a need for companies to adapt. And I think using ESG factors, companies that do well alongside environmental, social, and governance factor would be able to adapt and thrive in a post-pandemic world that is much more complex and much more difficult to operate. Why is it so? Because companies that are doing well, it's quite intuitive to understand in the sense that a company that uses its resources well, and of course, resources would mean the land that it's on, the natural resources around it, but also the human resource. And that's where the social and the environmental factors come in, would tend to be able to adapt to a much more complex world. And of course, you need very strong governance factor and good leadership to bring about all these together. And of course, if you have happy employees, you get much more productive work from them. And therefore, the company as a whole would do much better. So therefore, I think not just only on the hard matrices of profitability and efficiency, companies that do well on the ESG factors are also very crucial in the years ahead, because they will be better able to thrive in a much more complex world, and also to avoid issues associated with reputation risk and legal risk. So ESG leaders, we think, will do very well because of a much more complex environment. But also, I think as much as Europe is on a sort of a green revolution, especially in terms of energy transition, Asia is also on the cusp of its own green revolution. Southeast Asia will need to spend $210 billion a year on climate resilient infrastructure from now to the next decade. That creates enormous amount of investment and opportunity. Similarly, in a bigger case in China, China will need more than 200 trillion RMB to reach carbon neutrality by 2060. So there's going to be a huge investment team which would manifest itself from energy transition, from smart building technology, to even infrastructure that allows much more energy efficiency. And clearly, Asia would account for 22.5% of the world outstanding green and sustainability linked bonds. And therefore, I think that's going to be quite a lot of investment opportunity set for the green transition in the years ahead. And of course, the opportunities for sustainability is on multiple levels. You can think of it through on a thematic way in which you want to find themes like energy transition, find themes like water scarcity, or even the circular economy and invest in those. But I think at the heart of it, it's really integrating ESG into your investing, whereby you want to select companies that do well on the ESG scores into your core diversified portfolio. And thereafter, once you form a core portfolio, you can explore thematics such as some of the themes I mentioned, whether it's green energy, whether it's smart infrastructure, whether it's climate resilient infrastructure, or even circular economy that uses waste in a more productive manner. I think these are the themes that one could look out for in the sustainability area. But also, I think this whole sell-off has created a lot of investment opportunities, especially in Asia. Asia is home to multiple world number one leaders, the number one solar panel company, the number one lithium ion battery maker, the number one smartphone producer, the number one semiconductor manufacturer. So Asia is home to many champions in that sense. And as a result of the pullback, it has actually created a very good entry level for many Asian champions. And I think that in a much more complex world in the years ahead, you would see winners winning bigger. And I think that's going to be a very crucial aspect going forward. And I want to speak very quickly about Southeast Asia. Southeast Asia has been one of the best performing markets in the world from a year-to-date perspective, really because Southeast Asia has been better able to adapt to these disruptions from the pandemic, disruptions from the war, and disruptions from climate change. And I think one very important aspect is also that Southeast Asia is reopening to the pandemic. It is allowing much more tourism to recover in the region, and is benefiting from the trend called revenge travel, in which travel that was pent up over the last 2 years is being overloaded right now. And I think that's one trend that Southeast Asia is benefiting from. But also, I think Southeast Asia has, through the RCEP, or the Regional Comprehensive Economic Partnership, the world's largest free trade agreement, come together to integrate trade investments for the region. Because if you think of the region as a whole, Malaysia and Singapore with very strong manufacturing of semiconductors, Indonesia with its natural resources, especially now a lot of nickel deposits, and also Thailand with its automotive capabilities. And you combine this region as a whole, it's actually going to be quite a formidable manufacturing hub in the years ahead, especially one that rides on the sustainability revolution. So I think there is a lot of opportunities in Southeast Asia, and also because of how Southeast Asia is adapting to these challenges and disruption. Southeast Asia has been a very strong performer, and we are bullish on Southeast Asia since even before the year started. And I think that call has worked out well, and we continue to be bullish on Southeast Asia. Especially we like Singapore market really for its income quality companies that gives you very strong dividends. We also like Indonesia because of its consumption and resource exposure, as well as Thailand that would benefit from the revival in consumer, especially in tourism. And of course, I think Southeast Asia is poised to benefit from a consumption revival that we're going to see take place from now to the second half of this year. In terms of investment strategy, I think the current market condition is extremely volatile. Our main case, our base case, is that we will not get a recession, as how I've argued, that the inflation reading in the next few months is going to be high and volatile. But by September, it should start to peak out, and slowly inflation should start to ease. Really because the Federal Reserve is on a tightening bias, and that increase in interest rate is starting to bite and slow down the economy. But also on the supply side, there are some improvements in terms of labor market. You're getting the shortages are being met, especially on the labor side. and also certain segments are starting to improve, especially as China's supply chain starts to normalize. And of course, we don't think a recession is our base case. But let's say if it is also plausible in our worst case scenario, if, for example, if inflation continuously becomes much higher than we expect, if inflation goes above 10, 11, 12, or even 13%, and maybe and it doesn't seem like it's falling, and then that might force the Federal Reserve to increase even more in terms of interest rates, and the markets will price in even larger rate hikes. That might trigger a recession. That's not our base case, but if that occurs, of course, you're going to expect the strategy to be very much different. But also, as much as you consider the worst case, you also have to consider kind of a best case scenario in which the economy rebounds much stronger than most people expect, and the inflation subsides because those supply factors start to kick in. And of course, if you do get an economic rebound, the economy will improve, stock markets will rebound strongly. But I think if we keep with our core case, we want to, again, focus on quality companies. We want to focus on income. We want to balance between value and growth. And we want to look in terms of bonds into the shorter maturity, especially on the investment grade side. And in terms of currencies, our base case would be amount, dollar appreciation. But I think the longer term implication, of course, is that if we are in this higher inflationary world, that means that interest rates are no longer zero. I think the key message is that from now on, there is a price for money already. And as a result, what we've seen is that in the past decade and a half, where we had zero interest rates, bonds and equities actually move up together. And in fact, during the last 15 years, you can just buy the US market and you'll do much better. There is the need for global diversification is not that strong. But I would say that in this world right now we are in, with interest rates ratcheting higher, with inflation around, because in the past 15 years, there wasn't inflation. Central bank could keep interest rates zero. They could do huge amounts of QE, but those things are changing. It is an end of easy money. And as a result, the need for global diversification is more important, because you can't just buy equities and bonds in a particular market. You need the exposure to be global. To have a global exposure, you need to look into alternative assets, particularly real assets, and also commodities, to get that diversification. And of course, the macro environment is going to be much more volatile. Economic cycles are likely to be shorter, induced by perhaps disruptions, whether it's pandemic or conflicts. And therefore, I think creating market volatility is going to be very high. And I think it's very important to build income into your portfolios, but you have to look at multiple income streams, whether it's through bonds, floating rate bonds, floating rate notes, or bonds that can reset its coupons in higher rates when inflation goes higher, or even through REITs that have strong income that would be able to pass it on to its investors, or even in terms of income from infrastructure assets that typically go higher in an inflationary environment. And I think one important aspect is that in the past decade and a half, you had low interest rates, in which it caused a rising tide, and nearly all boats were lifted as a result. But I think that approach will not happen already. You have to be much more selective. Security selection is going to be key. You need to buy into companies, winners that could kind of win in this post-pandemic world. And I think the winners will win big. You just have to pick those companies that are quality companies that are able to be positioned for long-term trends, such as digital transformation, such as the sustainability revolution, and they are able to increase their margin despite rising input costs. And I think the companies that don't do well will be those that are highly leveraged, that don't have pricing power. They will go under. And it will give it a period of consolidation in which some of these winners will be able to buy up and gain market share. So I think that there are opportunities, but of course you have to be much more selective going forward. And I think just looking at diversification, staying invested, being diversified, and just a proxy of having a third into global equities, a third into global bonds, and a third into global alternatives. And what we have seen is that if you had been invested since, let's say, 2018, you would have during the 2020 March sell-off, you would be fairly resilient, but you would have bounced back in terms of investments and done very well. And I think that this time round, if you are diversified, as how we've prescribed, you will be able to bounce back even this time round. And I think that's really the message, to stay invested and to be diversified globally. I think that's where if you build that portfolio well enough, this is just a simple example, a simple proxy. It is actually fairly resilient in terms of its performance, even during the 2020 pandemic and even during this year's sell-off. So I think to summarize, really, we have really three points. You want to look for quality. So quality companies with strong margin power to ensure earnings delivery, companies that are positioned on structural growth opportunities, and a lot of these companies would have very strong ESG scores. And you want to look at multiple sources of income, whether it's through bonds, dividend, stocks, REITs. If you can, you use volatility strategies through structured products, or even, and most importantly, I think diversification is extremely crucial, and you want to be diversified across all asset classes. And I think once you have achieved this diversified portfolio as your core, you can be actually quite confident to think long term, because as how I've demonstrated that a diversified core portfolio is actually very resilient. It gives you the income. It doesn't. It's not so volatile. And then once you have that, you could start to think about longer term themes created by the disruptions, longer term themes such as the return or the remaking of Asia, longer term themes such as sustainability, longer term themes such as digital transformation. So I think with that, I want to take a pause here, and I want to hand the time back to our moderator, Swati, and we'll be happy to take the questions that you all might have.
Thank you very much, James, for very insightful sharing. Now we open for Q&A. So ladies and gentlemen, you can continue to type your question and send to us. Okay, let's come to the first questions. This is a very interesting question. So James, do you see, because market right now is so volatile, do you foresee market can further drop? And whether investor should stay invested or sell off first, then come back again when market more stable?
Great question. Well, I think the next month or two is going to be extremely volatile for markets, really because there isn't an anchoring of inflation yet, which means that whatever the Federal Reserve has done in terms of hiking rates, Federal Reserve is watching what the impact will translate into how inflation would fall from there. So I think that's something that's still not sure. So I think from that perspective, as long as inflation does not peak yet, and you have to wait for the readings to come, you're going to get quite a lot of repricing that's going to occur, especially on the interest rate front. And when there is repricing of interest rate, especially repricing higher of interest rates, most risk assets will be affected because it's actually a present value of future cash flows. So as a result, you're going to get a lot of volatility, but the volatility I think would differ for different assets. Of course, short-dated bonds will be affected less compared to long-dated bonds. In the equity sector, value will be affected less compared to the growth or technology sector, which some parts of technology sector would have very low earnings visibility. So those will be affected more as interest rates increase. But having said that, what I would want to say is that I think we've probably seen the worst in terms of the sell-off since the beginning of the year. If we do get that base case scenario, you might still see another 5 to 10% of volatility or downside from here. And if we don't get a recession, you should see things gradually improve, especially if we think that by September or so, inflation will start to peak and slowly improve from there, then there is more clarity around what the Federal Reserve will do, and then you should get that recovery. So I would say it's going to be very volatile, I think, in the next 1-2 months. But what I've also illustrated is that if you had stayed diversified in a global portfolio, it's actually quite resilient, and you could actually tide through this current volatility rather than people. Because what we have noticed is that typically people who have try to time the markets typically underperform, because it's not really it's very hard to sell out at the highest of the high and then you buy at the lowest of the low. Typically, most of the time when we see investors, they typically buy at the highest of the high and they sell at the lowest of the low, and they don't come back. And that's what we observe. So it's more important to lay out a right strategy, a diversified global portfolio, and it's time in the market rather than timing the market. That means you want to stay in the market for a long time. That's more important. And I think for those who have not invested at all right now, I think the current pullback and sell in markets provide very, very attractive entry levels to start building your portfolio, because it will give you a very good position in the years ahead. And of course, if you think of it through the cycles, through the long term, time in market matters more. You want your investments to give you that compounded return over time. And I think that's where my advice is, that this disruption right now, especially for those who are underinvested, is actually a very, very good opportunity to start thinking about building your diversified portfolio.
Thank you, James, for your advice. Yeah, it's true. We need to be more patient, and very difficult to predict the market, but stay invested with well-diversified portfolio. So, James, for the second question, yes, for our HSBC base case, we are not expecting a recession to happen. But what if for the worst case, maybe not this year, but next year or futures, there is the recessions? What your advice for your investor to positioning themselves?
Yeah, I think the reason we should not ignore that it's a risk, definitely. And of course, the risk is rising right now. And that's why I show that chart, to show that our base case is not recession, but if, let's say, if inflation doesn't fall, and the Federal Reserve, and it keeps rising higher and higher, and the Federal Reserve have to hike rates even more, and the expectation of that trickle down to the financial markets, that could trigger a recession. Currently, I think what the markets are pricing in for the Federal Reserve is the terminal rate. That means at what point are they going to stop increasing interest rates? It's around 3.5 to 3.75%. That's what the market's expectation is. So I think at that 3.5 to 3.75, which means that's the rate that the Federal Reserve will stop increasing interest rates. And that's sometime around 2023. So if that is the case, that's the base case, and that's what the Federal Reserve say they will do, you should not get a recession. But let's say if inflation becomes much higher, 10, 15, I don't know, even higher than that, so higher than 15%, and that 3.5 to 3.75 has to be even higher than that to become 5 to 5.5% in terms of Fed funds rate, that would trigger the world into recession. We are not there yet. The probability is rising, but it's not. But it's something that we have to watch out for. Then the question is, what should investors do? Clearly, I think again, what we have demonstrated is that by staying diversified, of course, you can tide through that recession even, as how we have seen the 2020 pandemic recession, how those portfolios have actually bounced back. But also, I think in the short term, in terms of bonds wise, I think if you do get a recession, you want to buy into bonds, because bonds will do better, particularly the investment grade side of bonds. And in terms of equities, again, you want to be a bit more cautious on equities, because equities would sell off even more. If we do get a a repricing of a recession or a 5% type of Fed funds rate, you could easily see another 20% pullback in equities. So that is not our base case, but if that happens, so you want to pare down a bit on equities. But nevertheless, I think and of course, in terms of currency, the dollar would increase tremendously as a result. So I think if we do get that scenario, again, you want to have that strategy of being diversified, but yet I think you also can have some kind of spare gunpowder in a sense to keep your gunpowder dry, to use such pullbacks to build up your investments. Especially, I think markets that would sell off significantly, sectors that the quality companies, the champions, the big companies that would win in the digital and sustainability revolution. Those companies you want to buy during big market pullback. So I think one should kind of see it objectively. You don't need to be kind of prepare for the worst case scenario. Once you have a kind of a core portfolio, a core diversified, globally diversified portfolio, once you build that up, this is the time to slowly build it up. You need not build it overnight, but spend, you can always phase it in terms of a dollar cost average. And also, I think keep some gunpowder dry in case you do get that worst case scenario. And I think that would provide even a better entry opportunity. And that would be a time where you could kind of add into some of the riskier sectors like equities, which would have pulled back a lot. Thanks for the question.
Thank you, James. So, James, the next question is about China. Especially this year, we know China will be a president election for their National Congress. So, what are your comments about the China market outlooks and how the president election will impact?
Yeah, well, great question. I think for China's case, it's currently we are neutral on China. And we are watching the economic indicators. I've shown earlier on that they have been easing monetary policy, and that means they allow much more credit to enter the system. And typically, when the credit enters into the system, the economy will rebound. We haven't seen a sharp rebound in the economy yet, but I think that's something that we are watching out for. Perhaps it's going to happen towards the end of this year, and perhaps also aligned with during the time of their leadership meeting. But I think what's very clear is also you want to see the general direction of where the country is going. And I think the key, clearly, I think since last year, they are moving towards a strategy of common prosperity, which means they want to grow the entire economic pie, not just for the wealthy, but for everyone. And I think that makes sense in that over the long term, there is sustainable and equitable growth for the country. And over the last 2 years or so, they have looked at certain sectors, whether it's education, housing, or even healthcare, to make it affordable for all. And it has created quite a bit of uncertainty. And I think during that leadership meeting, it's going to be a reinforcement of that direction of common prosperity. And I think to provide greater clarity on how the country is going forward. And alongside that, of course, it's how they view the zero COVID policy as well. That's also very crucial on how they are going to hopefully shift, but it's hard to predict the direction of it. But certainly, I think that's going to be something that a lot of analysts are watching out for. But to me, I think at the end, it's really about whether is there a pickup in the economic momentum. And I think for investors, this is clearly a market that has kind of pulled back significantly since the last year and a half. And I think levels are extremely attractive. Will it get a V shape right now? Probably not. But we are watching out for all these indicators. And of course, China strategically should be part of every investor's portfolio. And of course, if investors do not have any exposure to China, one should actually start looking out at China strategically and slowly look at some of these indicators. If these economic indicators start to kind of pick up, I think it could be a signal to add on to China exposure. But meanwhile, we are neutral on China. We're still on a wait and see mode.
Okay, thank you, James, for your guidance. So further about these asset allocations, just now because you mentioned we are neutral on China, and we also expecting maybe China will not be V-shaped rebound in very short time. So what about the investor portfolio allocation, like between the US equity, global equity, and China equities?
Yeah, well, great question. I think as of now, we are actually overweight on the US. Because of the growth prospect. US consumer is still very strong. 70% of the US economy, it's actually a consumption. So US economy is still strong. We stay overweight there. China, we are neutral. We are overweight on Southeast Asia. So I think that's how we should kind of look at equities. First, you have to have a strategic asset allocation. And when we overweight, we just probably add a bit more compared to our strategic asset allocation. So that overweight view is a 6-month view, but we want to kind of build up that allocation. So in terms of, remember, I did mention you should have around 1/3 exposure to equities. And for US, we think you should have around 20% exposure to the US. And of course, in terms of Asia-wise, largely about 6 to 7%. And that's where we think one should kind of have in terms of asset allocation, in terms of strategically. And of course, the overweight, underweight is just 2 or 3% above that.
Thank you, James, for sharing your views. James, can you please comment about the bonds market, especially the China bond market, those related to property sectors?
Well, thanks for that. I think the good news in China is that at least we are seeing right now, in terms of some relaxation of the zero COVID policy, especially for some of the major cities. So I think that's positive because what we had was almost 2 months of lockdown in Shanghai and major cities. And as a result of lockdown, you can't do any property viewing at all. So now with relaxation, I think there will be a pent-up demand for property transactions. And I think we are seeing very early signs of a pickup, especially for property transactions. So that's a positive. And another positive, of course, is that we are hoping to see the feed through in terms of the economic momentum. So that's what we are watching out for, which would be positive for the property market as well. And of course, the third part is policy. They have been, over the last year and a half, China has gone through its own deleveraging process, especially for its property developers and its property sector. It went through a kind of a tightening of its own property sector in terms of its financial ratios, in terms of its debt levels. So it has brought down the debt levels significantly since the last year and a half. And there were many companies that could not function well, became insolvent. So I think that whole kind of weeding out process, it's probably done. There will still be companies that will not thrive, especially as interest rates increase. But I think what's important in terms of China bond strategy is you have to be very selective to pick up the winners. And of course, there will be some good companies, property developers that will give a good return on your investments. But I think in the short term, a lot of the property bonds will be first and foremost affected by what's happening in the global environment, especially in the US. I've mentioned that the US inflation expectation is not anchored yet, at least for next 1 to 2 months. And the Federal Reserve rate hike trajectory is good, it's up and open right now. And that to me is the biggest factor affecting bonds. And of course, China bonds will be affected by that. But fundamentally, on domestically, there are some signs that the worst is over the last 1.5 years is probably behind. Things look like it's slowly getting better. But of course, it's still too early to kind of declare everything is well in the China bond sector, really because the direction of the COVID policy is not clear. Zero COVID is not clear. And that you still need some time to watch out for. So I think the message really is to, if you want to invest in China property, I think you should stick with a kind of a manager that knows how to select the companies. I think that's very crucial because selecting is key. Try to avoid single exposure to 1 or 2 companies because that's very concentrated. You want a diversified exposure and you want to let kind of an active manager do that job for you because it's quite a tricky environment right now, and you want the manager to be able to balance, kind of be able to buy and sell company, because there are many policies are being changed at the moment, and it will affect different companies differently. So I think that's very important when it comes to China bond investing. Go with a diversified approach. Go with an active manager that has shown strong, credible results that beat the benchmark over the last 1.5 years. I think you go with those.
So thank you, James. James, please share with us the commodity, like the gold outlook.
Yeah, well, I think if our base case is right, if we are in the base case, then I think the upside to gold is not that significant. Really, because of rising interest rates, because gold doesn't give any increase in interest rates, doesn't have any interest rate, it's non-interest bearing. So if you do get a rise in interest rates, especially real rates, then I think that is a headwind for gold. But nevertheless, I think gold, one should always consider some exposure to gold as a diversifier. I think that's something one should look out for. But unless we do get a significant recession, otherwise gold probably has a role as a diversifier rather as something that has significant upside, in my view. Really, because one of the important factors is also that gold is actually the concept of real rates. Real rates, the difference between nominal rates and inflation expectation. So what I'm afraid is that although real rates can actually go up if inflation expectations fall, especially past September, because we think that by September inflation expectations should start to stabilize. But nevertheless, real rates can still go higher, and people would prefer investments that give them higher real rates rather than gold that gives zero interest rates.
Thank you, James. Due to time constraints, we think that I can only able to pick up the last one question before I let James to summarize for today's webinar. The last question will be the outlook of the Forex. What about the USD and Malaysia Ringgit outlook?
Yeah, well, thanks for that question. Well, I think in the short term, you're going to expect stronger US dollar, really because of first interest rate differential and also because of uncertainty. US is hiking very, very quickly. They just did 75 basis point increase in terms of interest rate. Likely the next round in July, they're going to do the same, another 75 basis points. So it's very hard for many countries to catch up in terms of that rate hike. But the issue is, of course, there is a real inflation problem in the US, while it's less so in Malaysia. So I think that short term, I think dollar strength, but I think towards the end of the year, the Malaysian economy is doing well on multiple fronts. Consumption is strong with reopening. Industrial production is also very healthy. So I do see the ringgit kind of strengthening towards the second half of this year. If our base case scenario is right, if we don't have a major recession, there is mild dollar strength, but I think the ringgit can Malaysian ringgit can actually strengthen a little bit towards the end of the year. But definitely, I think the next 1-2 months is going to be a time of dollar strength. Thanks for the question.
Thank you. Thank you, James. We apologize for the time constraint that we're unable to answer all questions during this platform. So dear value customer, please keep in touch with your relationship manager for further discussion. So now we're about to end. We would like to invite James again to summarize a few key points for today's webinar.
Yeah, well, I think that I would say that it's very important to be globally diversified. I think that's crucial. And for investors that are not invested yet, you have hardly any exposure, mostly cash. Cash is going to be a trash, because with inflation, cash value drops. So you want to be diversified. And now I think most global assets are at very attractive level. So it's good time to have a conversation with your investment advisor, with your relationship manager, how you start that process. And I would advise don't throw in everything at one time. You kind of phase it out over several months because the outlook is unclear, but you are getting very attractive price levels. But again, then I also have the advice also for those who are already highly invested, then what do you do? I think it's very important to first also go back to you want to be optimally diversified. I've showed some examples of the percentage in terms of weightage to bonds and equities. If your allocation is too high, you might want to rebalance it lower. And you want to, as you rebalance, you want to look for a few things. You want to look for quality companies, and you want to look for how you build income into your portfolio. And I think you rebalance to that. And of course, our advisors are more than happy to provide that solution for you. And typically, achieving a globally diversified portfolio is very, very important. And I also can imagine also a lot of investors right now, especially in Malaysia, are highly exposed to local stocks, Malaysian stocks. I think in the next few years, as I've explained, in the past, when interest rate is zero, almost all assets do very well. Remember, early part of 2021, we haven't had meme stocks doing very well. But now I think with interest rates going to be higher, there is a price for money. There is a hurdle rate. Not all assets. The rising tide will not lift all boats. And therefore, I think if you have big exposure just in local equities, you want to think about how you're going to diversify it. And I think that's going to be a very important thing to think about, because the strategy that worked well over the last 5-10 years might not work well in the next 5 to 10 years. And I think that's where we want to help you in this journey. And I hope that this webinar provides some food for thought. And I think that what's more important is your next conversation with your relationship manager, which will take it deeper into much more actionable decisions for you.
Thank you very much, James, for the wrap up and very, very insightful sharings. Ladies and gentlemen, I also would like to take this opportunity to thank you for attending our webinar for 1 hour. I believe everyone managed to have some key takes away for today. Thank you, everyone. We'll end our webinar now. See you again. Goodbye.